I'm Ben Kirby, co-head of investments at Thornburg Investment Management. Markets attempted to rebound at the beginning of the third quarter as investors thought the risk of runaway inflation was subsiding. However, it proved to be a bear market rally as global inflation prints came in hotter than expected and central bank rhetoric turned increasingly hawkish, led by Fed Chair Powell, who made it clear that driving down inflation is the Fed's top priority. As a result, it was more trick than treat for equity markets to end the quarter. We continue to navigate through the fog, and the outlook requires an even greater than normal degree of humility as a portfolio manager. Are we transitioning to a structurally higher inflation regime, or is this a temporary dislocation due to the policy response to COVID? As we attempt to answer these questions, we face a distribution of possible risk asset outcomes that has fatter tails on both sides. These tails are interesting to sort through and flesh out what could go right and what could go wrong. On the left tail side, risks include a deeper than expected recession driven by sharply rising interest rates. On top of that, the strong dollar adds heat to an already hot kitchen that could spill over and cause financial distress that we aren't seeing right now. But as we've seen before, when we've been aggressive around global monetary tightening, something has broken in the global financial system. On the other extreme, risks center around the possibility that the Fed pulls off a soft landing for the U.S. economy. As then Fed Chair Ben Bernanke famously said in 2004, if making monetary policy is like driving a car, then the car is one that has an unreliable speedometer, a foggy windshield, and a tendency to respond unpredictably with a delay to the accelerator or the brake. That analogy still applies today, adding appreciably to both the left and right tail risks in equity markets. Despite the Fed's aggressive tightening over the past few months, we have yet to see its full impact on the U.S. economy, which remains strong as the impact of higher rates is lagged, long, and variable. Inflation is running hot, and wages are moving higher even as initial unemployment claims remain at near 4-decade lows. The Fed is trying to engineer a soft landing, which is just a slowdown, hoping it will be enough to bring inflation down. But as Chairman Bernanke eloquently put it, this is more art than science. I don't want to ignore the right tail risks, which are primarily rooted in the possibility the Fed can tame inflation by engineering a mid-cycle slowdown rather than the end of the cycle. In this Goldilocks scenario, earnings estimates would prove resilient in nominal terms if companies can pass on higher prices and consumers are able to absorb the blow by spending down excess savings. In this right tail scenario, bearish sentiment reverses as discounted asset values suddenly look quite attractive. The coming earnings season is crucial to how we view the rest of the year and into 2023. We are watching closely to see what companies are forecasting in terms of real-time demand for their business and how extensively they guide down 2023 earnings expectations. From a bottom-up perspective, Street consensus still forecasts 4% growth in 2023. However, we are skeptical of that, and we see that as a best-case scenario, so expect choppy markets to continue in the coming weeks. On the valuation side, the S&P 500 index is back to about 17.5 times trailing earnings, which remains above the long-term average. On the simple yardstick, the market valuation is certainly more attractive than it was at the start of the year, but it's not at a level we'd consider cheap, especially in a high inflation regime. Looking to European equities, they are heavily discounted, and for good reasons. The recession in Europe is likely to be deeper than what we will experience in the U.S. That said, the relative discount of European stocks on a sector-neutral basis is wide, and we are looking for opportunities there. Remember, investing in European companies does not necessarily mean investing in Europe alone, as many of these companies have global reach. As for China, we remain largely perplexed by Beijing's insistence on its zero-COVID policy. It amounts to a self-imposed economic tax and is driving social unrest with youth unemployment now over 20%. Chinese investors have a lot more of their wealth in real estate than they do in stocks or bonds, so the wealth effect of property prices falling is another negative. Until China resolves the zero-COVID policy, it seems unlikely the market can sustainably outperform. The U.S. remains the global investor safe haven, hence the strength of the dollar. As long as the Fed keeps tightening and the specter of left tail risk remains top of mind, investors will continue to hide out in U.S. stocks, bonds, and the dollar. But once we start to see the Fed policy pivot, signaling that the economy is slowing in an understandable but not deep recessionary way, that's when a lot of things can happen all at once. The dollar would likely peak and international assets would likely begin outperforming. We can't predict when that will happen, but from a diversification standpoint, It should signal that holding international exposure could be an investor's ace in the hole, even in this U.S. weighted market.